Hey everyone, Longacres Finance here, and today we will be taking a closer look at the top 3 quality dividend stocks from the February watch list. Those 3 stocks are Schwab, Domino's Pizza, and United Healthcare. I will be taking a look at each company's revenue, earnings, dividend history, and we will make some forward-looking assumptions on what type of return we can expect from each stock in the future. Let's jump right in and start with Schwab. Schwab's revenue stream has been growing steadily year over year for the last decade. We can see that they have been averaging just shy of 11% year-over-year revenue growth. That is a very nice and consistent pattern. Their earnings have seen a similar growth pattern, averaging about 14% per year, even with the recent decline in earnings for 2020. The reason Schwab saw lower earnings in 2020 is the current low interest rate environment we are in. It isn't favorable to their business model, as Schwab usually derives 60% of their revenue from interest income. This could be a drag on their future earnings, as low interest rates are here to stay for a while. However, there are other ways for Schwab to continue growing their revenue and bottom line, like reducing costs. Their recent merger, or rather acquisition, of TD Ameritrade should allow for some cost reductions and could strengthen other revenue streams. Schwab currently pays a quarterly dividend of 18 cents per share. Based on their current share price of about $56, this gives investors a 1.29% dividend yield. While that is a rather small dividend yield, it is a premium one by Schwab standards. Historically, the stock has traded with a sub 1% dividend yield, and their trailing 5-year average yield is 1.04%. Schwab has been growing their dividend for 5 years now, at a phenomenal rate of about 24.57% per year. This is a very nice growth rate, but a pretty short growth history. If you're enjoying the video, please click the like button and subscribe to the channel to be notified of future videos. Schwab's current payout ratio hovers around 25%, which is very low and leaves plenty of room for future dividend increases. CFRA expects Schwab to grow their earnings per share at a rate of 7% per year over the next 3 years. They also have a 12-month target price for Schwab of $68 per share. Based on their target price and Schwab's current price, this would imply a 23% potential gain, should their prediction prove to be accurate. Using dividend yield theory, we compute Schwab's fair price to be $69 right now, which is in line with CFRA's 12-month estimate. Let's assume Schwab can grow their dividend over the next 3 years at the same rate as their estimated earnings per share growth of 7%. If Schwab can grow their dividend at this rate, and return to fair value based on their trailing dividend yield, we can expect to get an annualized rate of return of 15.76% on our investment. This is based on stock price appreciation of 14.47% per year, with the current dividend yield of 1.29%. This is a very respectable return by my standards for a core quality dividend stock. Let's jump over and take a look at Domino's Pizza right now. They have been growing their revenue year over year for the last decade, averaging about 10.5% growth per year. Their earnings per share have also grown year over year for the last decade, averaging about 24% growth per year. This implies that in addition to growing their top line revenue, Domino's has also been streamlining their operations to grow their bottom line even faster. They currently pay a quarterly dividend of 78 cents per share. Based on their current share price of about $383, this gives investors a 0.82% dividend yield. That is quite a low dividend yield, and as you can see on this chart, there haven't been too many opportunities in recent history to pick up shares of Domino's for a larger dividend yield. Their 5-year trailing dividend yield is 0.96%, implying that Domino's is trading for a premium right now. Domino's has been growing their dividend for 9 years now, and averaging an impressive 20% growth rate over the last 5 years. That is an excellent growth rate, and a solid streak approaching 1 decade now. Domino's payout ratio is a very low 25%, and offers plenty of room for future dividend increases. CFRA expects Domino's to grow their earnings per share over the next 3 years at a rate of 12% per year. They also have a 12-month target price for the stock of $450. Based on this target price and Domino's current price, this implies a potential 17.49% gain should their prediction prove to be accurate. Using dividend yield theory, we compute Domino's fair price to be $325. That is about 15% lower than the current price of the stock. Let's assume Domino's can grow their dividend over the next 3 years at the same rate as their estimated earnings per share growth rate of 12%. If they can achieve this dividend growth rate, and the stock will return to fair value based on their trailing yield, we can expect to get an annualized return of 6.83% on our investment. This is based on stock price appreciation of 5.99% per year and the current dividend yield of 0.84%. That is a rather low rate of return, implying that Domino's will need to continue to trade for a premium if investors expect to get a decent double-digit rate of return in the near future. Let's move on to United Healthcare now. United Healthcare has been growing their revenue year over year for the last decade, averaging almost 11% growth per year. They have also grown their earnings per share year over year, averaging almost 15% growth per year. That is very solid top line and bottom line growth. UNH currently pays a quarterly dividend of $1.25 per share. Based on their current price of about $330, this gives investors a 1.4% dividend yield. Dividend yield usually does not fluctuate much, but is currently trending slightly above their trailing dividend yield. The 5-year trailing dividend yield is 1.39%, implying that UNH is trading for a discount right now. They have been growing their dividend for 11 years now, averaging a growth rate above 20%. That is a very strong growth rate and a good history of dividend growth. Their payout ratio is a very low 27% right now, which leaves plenty of room for future dividend increases. CFRA expects United Healthcare to grow their earnings per share over the next 3 years at a rate of 12% per year. They also have a 12-month target price of $391 for the stock. Based on this target price and their current price, this would imply an 18.48% potential gain if the prediction proves to be accurate. Using dividend yield theory, we compute a fair price of $360 for UNH, implying they are potentially trading at a 9% discount right now. Let's assume UNH can grow their dividend over the next 3 years at the same rate as their expected earnings per share growth rate of 12%. If they can achieve this growth rate and return to fair valuation, we can expect a 16.78% annualized rate of return from the stock. This is a combination of price appreciation of 15.24% and the current dividend yield of 1.54%. That is a very solid rate of return from a solid quality dividend stock. Let's do a quick recap now. Based on CFRA's 12-month target prices, we can expect very good double-digit growth from each of these 3 stocks. Dividend yield theory suggests Schwab offers the most potential upside, and Domino's is currently the most overvalued position. Using anticipated future dividend income and a return to fair valuation, we can expect double-digit growth from Schwab and United Healthcare, and a rather low rate of return from Domino's. Keep in mind, these are just estimates, all based on assumptions, and should be used just as such. Don't place too much emphasis on the exact numbers, since they can change rather easily based on the assumptions we make. I like to run these type of forward-looking assumptions to confirm my expectations. I currently own shares of all 3 companies in my portfolio. Schwab and United Healthcare are my 2 largest positions, and Domino's is number 7 in the list. I have set my target allocation for Schwab and United Healthcare higher than for Domino's, because I think those 2 stocks may offer more upside in the near future. Let me know in the comments below if you'd like to see this type of review for the other stocks in my watch list. Thanks for watching, see you next time.